So good afternoon, everyone. Thank you for joining us to this webinar, Understanding Credit Reports and Scores, hosted by us, Access Community Capital Fund, and presented by our community partners, Equifax Canada, and I'll be introducing Julie in a moment. Just to go over some information about Access so that all of you have an understanding of who we are and what we do. Today, we will be talking about credit reports and scores. I'm your moderator today, Otis Mushonga. I'm the Manager of Programs and Services at Access Community Capital Fund. Feel free to reach out to me following this webinar or at any time if you have any questions about our services, and you can also connect with us via our social media, as well as checking us out on our website, Access Community Capital Fund, www.accessccf.com. A few housekeeping, everyone will be muted for the duration of this webinar. We will be recording it, and so a copy of this will be posted on our website following the presentation. Allow us about 24 hours or so to post it on our webinar, and then you can feel free to access it as well. You will see at the bottom of your screen, you'll have a menu bar. If you're not familiar with Zoom, you can post your questions in the Q&A box, and you can also chat with us in the general chat box. So for all your questions, please do post them in the Q&A, and we'll go through them and we'll address them at the end of the presentation. For any technical issues, just do contact us in the general chat box. So a bit about Access Community Capital Fund. So we are a registered charity based here in Toronto, and we cover the Greater Toronto and Hamilton area, and we give everyone in our community the potential to achieve the best that they can through access to financial services, especially loans and training to help them achieve their potential so that they can achieve financial security through sustainable employment and self-employment. So we provide access to affordable loans and training to focusing on small business and career development. Our small business loans program helps those who have challenges getting access to loans through traditional means, through banks or other financial institutions or lenders due to lack of credit or not having adequate credit history. And that's why this webinar is particularly important in terms of bringing to light some of those challenges and how you can address any of the things that may go and impact you in your credit. Our loans up to $5,000 for small business financing give those who have great ideas, a great plan, and a viable business plan the opportunity to access the financing that they need to start a small business or to expand an existing one. And we offer up to $10,000 for returning clients or for those who are looking to grow their businesses. And we also provide supports around small business as well, not just the access to the financing, coaching, and training as well is part of the package. Our Foreign Credential Recognition Loans program helps newcomers who are internationally trained, who have the qualifications from outside of Canada and are looking to relaunch their careers here in Canada, and who may need to go through a licensing or licensure or training. This provides up to $15,000 for career-related expenses. So if anyone wants to pursue their career, whether it's the same profession or whether it's a related profession or it's a totally new career path altogether, and they can't get access to the funds that they need to pay for career-related expenses through other government-supported programs or through traditional lenders, this program is specifically designed to assist with that, especially for newcomers. And the challenge that many newcomers will face is that they don't have pre-existing credit, and this will be addressed in this webinar as well. So that's one of the challenges that most will face in terms of getting access to credit or to loans. So we provide and facilitate that through this foreign credential recognition loans program. Our Women's Business Accelerator program is a free training for business which equips newcomer women with the skills and tools that they need to start and grow a business here in Canada by providing them with the necessary foundation of the context, the Canadian context in which they'll be operating, and giving them the opportunity to develop their idea and to come up with a solid business plan, which they can then use to get further financing, and as well as through our own small business loans program. We are now accepting applications from eligible newcomer women for our fall cohort, which starts in early October. So feel free to visit our website at accessccf.com/Women's Business Accelerator. There is a link to the application, and feel free to share it with anyone in your network whom you feel may be interested or may actually qualify to be part of this program. Our financial partners are Eternal Savings and the Government of Canada, through whom we are funded. And we invite you to stay in touch with us, as this recording will be shared on our website. And if you have any further information that you may need, feel free to contact us, either me directly, or you can use the email that you see on the screen, admin@accessccf.com. So without further ado, I'm going to hand things over to Julie, who is our presenter today. And Julie is the Director of Consumer Advocacy at Equifax Canada. And Julie has a wide range of experience. And this is an area that is of particularly she's passionate about, and she speaks quite often, and I invite you to follow her as well on her social media. She regularly posts and some insights and some great information as well. So without further ado, I'm going to hand things over to Julie to walk us through the presentation, and we'll take any questions at the end of her presentation. And she'll be here to address. Just a note that we may go over the hour, and Julie is kind enough to stay and answer any questions. We do always anticipate a lot of questions when this topic is discussed. So be patient. If you're not in a rush, don't feel like you have to log off right away. You can still stay for a few more minutes well after the 4 o'clock mark. So I hand things over to Julie, and thank you again for joining us, Julie.
Thank you so much, Otis. I probably should have said that I'm happy to stay after 4 o'clock if I like the questions, but if they're not questions that I really want to answer, then I might need to leave right at 4. So you'll get a sense of what I think of the questions, I guess, when that happens. All right, so I'm going to take over the screen here, and please just want to double check that you can see this presentation. You can see the front page, Understanding Credit Reports and Scores. You're muted, Otis, so I will keep on talking under the assumption that you can.
Yes, I can. Your screen is visible.
Great. Okay, thank you for the confirmation there.
And everyone is confirming that they can see the presentation.
Wow, thank you. So it's such an honor to be here. Thank you so much for inviting me. And I particularly enjoy the new to Canada audience. I know it's a very tough situation to be in, to be resettling yourself in a new country, let alone during an unprecedented pandemic, and trying to figure things out. So thank you so much for joining us today, and it's really a pleasure to be here with you. So first of all, let's just talk about what we're even talking about when we say the word credit. It usually is getting something before you actually pay for it. So an easy example is a credit card, where you can use that credit card in a store to make a purchase, but you don't actually have to pay the credit card company, Visa or MasterCard or American Express, until you get your bill typically at the end of the month. So there you're making your purchases before you actually have to pay the money for them. Another type of credit is something like a car loan or a mortgage, where you borrow a larger sum of money in order to make a large purchase, like a car or a home. And those are called installment loans because you pay in installments. So you have typically a monthly payment that you set up and arrange as part of that loan, and that is the amount that you will be paying each month. Revolving loans, it's kind of a funny term. It refers to a credit card or a line of credit where once you pay some of it down, you get that amount back available to you to use as credit. So as an example, if you have a credit card that has, and let's use some round numbers, let's say your credit card has a limit of $100 on it, and you make a $50 purchase. So now you only have $50 of available credit on that credit card. Well, once you pay that $50 off, you go back to having the original $100 available to you. That's a revolving type of account. If you have a car loan, let's say that you have a car loan for $10,000 and you've paid $1,000 towards that car loan, that you still owe the $9,000, but you're not able to get any more money out of that loan the way that you are with a credit card, where once you pay some off, then you get a little more available to you. With an installment loan, you start out with a certain amount of money, and as you pay it off, that amount gets less and less and less until you end up at zero, where you've paid off the entire loan. That's the difference between installment and revolving. And then we have service credit, like a cell phone plan, where you get the service of using the phone and using the data for a month before you have to pay for it. So that's what service credit is referring to. So let's take a look at how this actually works in the Canadian context. So we've got the individual, it could be you or me. We use the term consumer to refer to just us here in Canada on the left-hand side here of this picture. And this person has 4 different credit accounts. The top one is a credit card. The next one is a cell phone plan, could be with a Rogers or Fido, TELUS, any of the players. They've got a car loan, and they also have a mortgage. In the middle, you can see the buildings. These are the companies that the person has the agreements with. And of course, it's not all going to be the same company. Maybe you've got a credit card from a large bank. You've got a cell phone from a cell phone provider. Maybe you've got a car loan that is directly from the car manufacturer. So these are all different organizations that you have your relationship with, and each one of them is sending you a bill every month. And whether that's by email or in the mail, you're getting a statement that tells you this is how much you owe this month, and hopefully you're paying that bill. And that information is being sent to the credit bureaus, which are on the right side of this diagram. And there are 2 major credit bureaus in Canada, Equifax and TransUnion. And most lenders and service providers send information on a monthly basis to both Equifax and TransUnion. So you should have a credit file at both Equifax and TransUnion, and the information on each of those 2 credit files should look pretty much the same. So we're going to dive into what that is a little more here. So this is a credit file. It also gets called a credit history, a credit report. Some banks refer to them as a bureau. What it is all the information that Equifax or TransUnion has about you that is related to credit. So this is a high-level summary view, but it would look pretty similar whether you're talking about your Equifax credit file or your TransUnion credit file. And sometimes I will use these different terms, credit file, credit history, credit report. This is what I'm referring to. So at the top, we've got our identification information. And this is because we want to make sure that we've got the right person's file here. So this is where we identify who you are. The next section is an access log of who has accessed your credit report. And that's actually a government requirement. That is a regulatory requirement that we are required to keep a record of every time a credit file gets accessed and who accessed it and when. And that's actually to protect the consumer. It's to protect you and me, because we have a right to know who is accessing our information and when. And there are a lot of rules and regulations around who can access credit reports and under what circumstances. So even though I work at Equifax, I can't go and look at anybody's credit report. That's not part of my job. Only people with certain responsibilities at the company can look at credit reports, but also at our client companies and at the banks. A bank cannot go and look at your credit report without getting your permission first or your consent to check your credit. And that often happens when you're applying for credit. So if you're at the bank and you're asking for a new credit card or a loan of some kind, or even if you're looking for a new cell phone plan, so maybe a Rogers or a TELUS, they're going to ask your permission. In order to open this account, we need to check your credit. Is that okay with you? And they have to record your consent. So you are either saying yes, you might have to sign something. If you're doing it online, there might be a tick box or something that you have to check that gives your permission for them to access your credit. And that gets recorded in the form of an inquiry. So anytime a credit file is accessed, the term we use for that is an inquiry. We would say there was an inquiry against that credit file or credit report. There are two types of inquiries, two categories: hard inquiries and soft inquiries. And the main difference is hard inquiries are related to the individual applying for new credit. So you are asking for a new credit card or a new loan or cell phone plan. A soft inquiry is the other category, and that's any other reason for accessing the credit report, including you going and getting a copy of your own credit report, which is something you have the right to do an unlimited number of times. So anytime you want to, you can access your own credit file at both Equifax and TransUnion for free. There are some ways that you might need to pay to access, but I'm going to talk a little more later on about how to access your credit report for free. So another example of a soft inquiry would be landlords. So sometimes you're applying for a new apartment or a rental accommodation. That landlords are allowed to check people's credit history as long as they have the permission from the individual. So when you're applying for this apartment, they might ask, can we check your credit report? And that would be a soft inquiry because you're not actually seeking credit from them. Now, one important distinction is that hard inquiries can have an impact on credit scores, but they don't necessarily have an impact on credit scores. And we'll talk more about that soon. Just wanted to plant the seed there. There are always a lot of questions about that. The next section on the credit report is public records. And this is typically negative information. This is where somebody has an account that they are very late on. So they got their bill, it said how much they owed, and they didn't pay it. Then they get another bill the next month that says, now you're 60 days late on this bill, and they still don't pay it. Then they get another one that says, now you're 90 days late, you're 3 months late on this bill. And if you still don't pay that bill, then it can go into a status called collections. And that would be recorded in the public records section of the credit report. Another example would be a bankruptcy that happened within the previous 6 years or so. That would stay on the public records section for that period of time. as well as legal judgments that are related to financial matters. So if you have unpaid taxes, if you owe the government taxes, for example, and they take you to court over that, and there is a legal judgment related to that, they tell you you must make these payments, that information can appear on the public records section. Another example of a legal judgment would be child support payments that aren't being paid. If there's a legal judgment there, that can appear on the credit report as well. The last section here is what we call trade information. This is the actual account information. So on the previous page where we saw that person that had the 4 separate accounts, a credit card, a cell phone, a mortgage, and a car loan, you would see those 4 accounts listed here in this section of that person's credit report. And you can see what some of the information is that would be listed about that account. Now, each account has its own credit rating, and that is an indication of how up to date the individual is on that particular account. Because you could be very late on one account, let's say on your credit card, you're 60 days late, but on your cell phone bill, you're paid and up to date. So you would see a different rating on each account that shows where you currently stand for that account. And these are some examples you can see here, R1 through R9. In this case, the R stands for revolving, and the number indicates where you're at, what your rating is for that account, how late it is. So 1 is always the best number that you want to see there. That means you're paid as agreed. Sometimes you see a 0. That means that the account is brand new and it hasn't been used yet. It's not always an R. Sometimes for a different account type, it might be an I or an installment loan. It might be an M for mortgage. It can vary there. Then we've got the credit score on the top right side. This is a 3-digit number between 300 and 900 that is a snapshot of the information that is in a person's credit report at the time the score is calculated. So there's a couple of important things to note here. One is that the credit score is not sitting on the credit report. A credit score is only calculated when it's needed. So credit scores can change all the time because the information in your credit report is changing all the time. One day the new information about your Visa account comes in for the March payments, and then the next month the information about the April payments come in, and so on. So credit scores can go up and down quite regularly. So what actually is a credit score? What's the point of this? I've heard some people describe it as an evaluation of your financial performance, almost like a report card in school. It's not quite an evaluation. It's a prediction. Now, some people say it's a prediction of the individual's ability to pay their bills. It's not quite a prediction of the ability because you saw on the credit file, there's no information there about what your bank account balances are, whether you have a job, how much your income is. Those are all factors that are part of your ability to make a payment. What a credit score actually is a prediction of the likelihood that an individual will pay their bills. And they were originally designed for risk managers at banks in order to help them make a decision on whether or not to lend to someone. So the idea that credit scores are based on is, if I ask you if I can borrow $10 because I forgot my lunch today and I really need some money to go buy lunch, you might say sure and lend me the $10, and then I don't bother paying it back. And then the same thing happens next week. Oh, I forgot my wallet again. Can I borrow another $10 so that I can buy lunch? Well, you might be like, okay, but can you pay me back this time? I need the money back. Oh, yeah, for sure. I'll pay you back. Sorry about that. And then another couple weeks go by, I don't pay you back. And I ask again, oh, hey, I need another $10. Can I borrow $10? you're not really going to want to give me the money probably, because I'm showing you that I don't do a very good job of paying you back. It's pretty understandable if you would say, no, sorry, I'm not giving you any money. You don't pay me back when I do. That's the idea of a credit report and a credit score. It's an indication of how likely you are to actually pay back the money that you borrow. And the idea actually came from trying to give a level playing field, or make sure that everybody gets treated the same way when you go to a bank or to a lender to request a loan. Before there were credit files and credit scores, if you imagine, say, 100 years ago or so, if you imagine someone going to a bank and saying, I would like a loan, please. I need some money because I'm buying a car and I can't afford it. It would probably depend on whether the bank manager knows you personally, or knows your family, or likes you, whether or not they're going to agree to lend you the money. So the point here is to make sure everybody's playing by the same rules. We all have the same information collected about us, and it's based on our own behavior. So the intent here is fairness across the board. Now, there are many credit scores that are used by different lenders today. There isn't just one number for each one of us. I mentioned that credit scores are calculated when they're needed. So if you go into some bank, let's say a CIBC branch, because you want to get a Visa card from them, they calculate your score. They might see, let's say, a 705, using this example here. And then you go across the street to a TD branch, do the same thing, you apply for something there, they calculate your score. They're going to see a different number probably, because they use different score versions. They understand that, and that's all part of their decision-making process. Often banks use a lot more than just a credit score in order to make a lending decision. So they don't just look at a score and say, oh, 705, is that good enough? They will ask you questions about, do you have a job right now? What is your income? How much money do you have in your bank account? They will ask more information, and that all goes into their decision about whether or not to give you the money or the credit that you're asking for. So even though there are different credit scores out there, the equations are a little bit different. They all take into account pretty much the same factors. And this is what those factors look like. So it turns out that the element or the information in our credit files that is most predictive of future behavior, meaning future likelihood to repay your bills, is past behavior. Have you paid your bills in the past? So previous behavior on your credit report accounts for the biggest slice of the overall credit score calculation. So that's payment history at 35%. And when I say previous behavior, I mean the behavior that is recorded on your credit report. That's the information that goes into the credit score calculation. It's not a moral judgment like, you ate 4 chocolate bars yesterday. That might not have been such a good idea. Therefore, we're not going to loan you money. That's not something that the credit bureau would know. And so it's not that kind of behavior. It's behavior, financial behavior of the accounts and the information that is available on your credit report or credit file or credit history, all those different words. Okay, so payment history accounts for the biggest part of the equation. The next one is what we call utilization. And this is about how much of your available credit are you actually using. So as an example, if you have a credit card that has, say, a $2,000 limit on it, meaning you can put as many purchases as you want on that credit card as long as they don't add up to more than $2,000. So let's say you make a number of purchases, $100 here, $20 there, and it adds up to $1,000. So you've got a balance of $1,000 on a credit card that has a limit of $2,000. That would be a 50% utilization because 1,000 is half of 2,000. So that's where that calculation comes from. This isn't saying that your utilization should be 30%. It's saying that that number accounts for about 30% of the credit score calculation. So the next question that you have is, okay, well, what is the right amount of utilization to have then? What should you aim for? There isn't one specific number because it depends on the other information in your credit report at the time your score is calculated because of the statistical analysis that takes place in order to do this calculation. In general, it's better to have a lower utilization, but there isn't any magic number that will shoot your score up. And this is what you're going to find is the theme here. This looks like a really great piece of information, and it is. What goes into a credit score calculation? But a lot of people look at this and say, oh, good, what's the secret? How do I make sure I get the highest possible score? And the answer isn't as exciting as a lot of people think it is. The answer is you pay your bills on time. That's how you get the highest possible score. That's what this thing is designed to predict. So if you show it the behavior that it's trying to predict, then you end up having a good credit score. Continuing through the factors that are involved in the credit score calculation, there's the credit history. So how long you've been using credit, as well as how long your different accounts have been open for. So typically the longer you've been using credit, especially with a solid history of payments that have been on time, then that tends to increase your credit score. It shows that you have experience using credit and that you're able to manage the credit well. That's not why this is a factor in the credit score calculation. It's a factor because of the statistical connection between these numbers, the age of the accounts, the age of the credit report, and actual performance of Canadians who pay their bills on time. That's how these calculations are designed, based on actual Canadian information. The last two categories here are the smallest. They're 10% each of the overall calculation. One of them is credit mix, so the different types of credit accounts that you have, installment loans, lines of credit, credit cards, and so on. Again, there is not a perfect mix to have in order to maximize your score. The best thing to do is just demonstrate that good payment behavior, paying your bills on time. And the last one is new credit, and that's shown in the form of new hard inquiries on your credit report, because hard inquiries are an indication that you have been applying for new credit. A hard inquiry will not always impact somebody's credit score. It can, but it doesn't always impact the credit score. And this is another example of something that varies depending on the other information in the credit report at the time the score is calculated. So here's the summary. I've just shown you and told you all this information, but kind of left you with nothing to work with here. Remember, the bottom line is make your payments on time. That's demonstrating that you will hold up your end of the bargain. That's what you agreed to when you signed that credit card arrangement or the loan agreement. You said that you would make your payments on time. Even if you have to make minimum payments on a credit card, say, it's important to make that payment before the due date. It's better to do that than to wait. If you know you're going to get paid 3 days after your due date, it's still better to put the minimum payment on the credit card before it's due and then pay the rest of it afterwards. That's a better move from a credit score perspective. So there's a little secret for you. Here's some information about how long different types of information can stay on your credit report. This means how long each one of these things could affect your credit scores. So the first one here is inquiries. We just talked about hard inquiries. They are what shows up on your credit report when you apply for new credit. After 3 years, they disappear from your credit file. So that means if I were to apply for a credit card today in 2020, then on this same date in 2023, that hard inquiry will disappear off my credit report. I want to draw your attention to collections. This is the third item down. So we talked about how collections are items that are overdue by 90 days or more. They are removed from a credit report 6 years from the date the item first went into collections. So they don't stay on the credit report beyond the 6 years. That doesn't mean that you don't owe the money though. So they're still allowed to collect after 6 years and try to collect the money from you. It just wouldn't appear on your credit file anymore after that period of time. Generally, it's 6 years. You can see the theme here in that column. You see a lot of sixes here. So generally, negative information will be removed from the credit report after about 6 years. And that's to protect the consumer, because we all make mistakes. Just going to go back to that slide for a minute. We all have times where unexpected things happen. We lose our job, people get sick, things happen. And so the idea here is any of these bad things that have happened, they don't have to follow you around for the rest of your life. After 6 years, that information is gone from your credit report. And as long as you aren't continuing to have missed payments or negative events happening on your credit report, even within that 6 years, as they get older and older, moving towards 6 years, it's going to have less and less of an effect on your credit scores. So these are intended to protect consumers, to protect us, so that we can recover from negative things that might happen financially. I'd like to touch on deferred payments that are happening as a result of the pandemic that we currently find ourselves in. I'm just going to give a quick overview here. There's an example that I would like to walk through just to show you what I'm talking about. So these are a couple of pictures from banks' websites. CIBC and BMO are the examples here. And they talk about financial relief programs for people who are having financial challenges as a result of the COVID-19 pandemic. One thing that a lot of banks and lenders are offering is deferred payments. So what does that actually mean? The bank is willing to give people that they approve for a deferred payment a break on their payments for some period of time. So if they say you can defer your payments for 6 months, what that means is you cannot make payments on this account for 6 months and not have it negatively affect you. Normally, if you chose to not make payments on an account for 6 months, it would go into collections and it would look terrible on your credit report and it would really drag your credit scores down. But because of the pandemic, the banks and lenders recognize a lot of people have had very difficult situations. And so they're allowing, it's not always 6 months, it depends on the situation with the individual, but a number of banks are allowing people to take a break from making payments. Now, they might add interest during this time, so it's not necessarily free money, but that's a totally different topic. This is an example of what the data looks like coming into Equifax or TransUnion, the two credit bureaus, on a monthly basis. So this could be, for example, it could be the CIBC Bank's Visa card customers. So it could be a list of everybody that has a Visa card with CIBC. And you can see there's a variety of information here. Some people, their account is in good standing, they're paid as agreed. These are the green examples. Some people have late or missed payments. These are the red examples. And then there would be some people who have a deferral where the bank, CIBC, has allowed them to not make a payment for some period of time. So these people are in a deferred status. This is relatively new. So as with many things with the pandemic, this is unprecedented. So Equifax and TransUnion had to spend some time together figuring out, how do we set things up so that people with deferred payments don't have it look like they're just not making payments? You don't want their credit report to say that they haven't made a payment for 5 months when they were allowed to not make a payment for 5 months. So you don't want that to unfairly affect their credit score. So I'm going to walk through a quick example, and if this feels a bit confusing, that's okay. I'm going to summarize it at the end, so don't worry too much. But here's the basic idea. Let's say that somebody has a loan where they have to pay $1,000 a month back to the bank. That's the arrangement of their loan. And the bank agrees, okay, you can have 6 months of deferred payments, so you don't have to make a payment for the next 6 months, and you won't be penalized for that. If no adjustments were made, so if the information was just being sent as normal to the credit bureaus, to Equifax and TransUnion every month, take a look at the green box here, second from the bottom, the number of days late. So before the pandemic, 0 days late. This person has been making their payments on time. But month 1, they're 30 days late. They didn't make a payment. Month 2, they're 60 days late. Month 3, they're 90 days late. Their overdue balance in the yellow box is going from 0. Initially, they didn't have any money overdue. Now they're $1,000 overdue in the first month. In the second month, they owe that $1,000 plus the new $1,000 they're normally paying each month. So now they're $2,000 overdue, $3,000, and so on. If we didn't go in there and make any changes or modifications for this person, they would look like they were doing some terrible things with their accounts. But that's not fair because they made this arrangement with the bank. So this is how we ended up fixing that. So if you look at the kind of red or purple colored column on the end here, so the blue ones, that's what we looked at on the previous page. On the red one, you can see the adjustments that are being made to this information about the account before it's being loaded into the credit bureau, so that it does not reflect negatively on the person who has made an arrangement with their bank. So if you take a look at amount overdue, the bottom, third from the bottom here, you can see that if we didn't do anything, what we looked at on the previous slide, it goes from $0 to 1,000, 2,000, 3,000. Well, in this purple row, you can see that the instruction is it has to stay at 0. There is technically no money overdue on this account because the lender agreed to allow this person to skip their payments for the next 6 months. So this is the idea. There are certain pieces of information that need to be adjusted for accounts that have been deferred so that they don't get negatively impacted on their credit report and therefore on their credit score. So we made sure that both Equifax and TransUnion are treating every account and every lender exactly the same way so that everybody gets treated consistently. And we talked to the lenders while we were making these decisions, and we said, okay, this is what we're looking at. These are the pieces of data that need to be adjusted in order to protect the consumer. Some of the lenders said, yeah, okay, no problem. We can do that. We'll make the changes in our system. So we'll send you the data that is adjusted the way it needs to be. Some of the other lenders said, actually, we can't do that in our system because it wasn't designed for that. We can't go in and change $3,000 overdue to a $0 overdue. So we said, okay, no problem. We can make those changes for you. And so both Equifax and TransUnion are working with the banks and other companies that send data to us each month and helping them make sure that all of these adjustments are taking place so that anybody that has a deferral or a special arrangement with their bank or lender or service provider doesn't get unfairly penalized for it on their credit report. So that's the deal with deferrals. There's a bit of information here around how to find a deferred account on your own credit report. So I'm not going to go through this with too much detail, but these are the fields that we just looked at. So past due, for example, should show a value of 0. There's a lot more information on our website at equifax.ca around how to find these, how to make sure that the data on any deferred accounts has been reported correctly. So this is an example of a paper credit report. So you can request a credit report for free in the mail, and it comes to you in the mail. This is what one of the accounts would look like. This is a Bank of Montreal account. And you can see on the second line where it says M1, that means it's a mortgage. And the rating is 1, meaning paid as agreed and up to date. You can see that there. So if this account were a deferred account, you would want to make sure that you see that, paid as agreed and up to date. The online version of your credit report is now available for free through Equifax. You can also, I believe, get a free credit report for free through TransUnion as well. So it's important to keep an eye on both Equifax and TransUnion credit reports. This just shows you where some of those fields are that you would want to double check if you have a deferred payment to make sure that they are being reported correctly. There's a lot of reference material on the Equifax website. So this box in behind is what you see if you go to equifax.ca. And if you look in where there's the blue square, there's COVID plus Credit Canadian Resource Center. And that's where there are a number of articles that are specific to deferred payments and other aspects of COVID and the overall credit ecosystem in Canada. So there's a lot of free reference information here if you are looking for more details. And I told you I would show you how to find your free credit report online. So this is the address for it. And I just want to draw your attention to, this is the page that you will see, this box here. You can see the little orange box where it says Get Started. If you click there, it will set you up, ask you the questions, and make sure you are who you say you are in order to provide your credit file or credit report for free online. You can see it says free next to that orange box. Down below in the gray box, it says Equifax Credit Score and Report, $23.95. That's if you want to get a score, a credit score, and your report. That's going to charge you $24. You have to put in a credit card number in order to get that. You don't need to do that. You don't need to pay for a credit score. You can just look at your credit file for free. That's the important part. That's where you want to make sure that the information on your credit file is accurate and what you expect there. You want to make sure there aren't any accounts listed there that don't actually belong to you. That could be an indication that somebody has used your information, your name and address, to apply for credit in your name. So it's definitely important to check your own credit report. And as long as that information is correct, then I wouldn't be so worried about your credit score. There are other places you can find your credit score. You certainly can buy it from Equifax. I'm not telling you not to. I just want you to know that you don't have to. So that's the end of what I had prepared for today. I am sure there are a number of questions that have come up during this discussion, so let's open it up to any questions.
All right, thank you, Julie. We do have a number of questions, so we'll just jump right in.
Okay.
And so, yes, to get us started, how often should people check their own credit report. And I think you've already answered part of that question, which is how do you obtain your free credit report? But how often should someone check their own credit report?
A lot of people will suggest once a year just to make sure that you're staying on top of it. I wouldn't want to wait longer than a year to check your credit report. Some people check every month. Some people get really obsessed and check every week. That's not necessary. I mean, if you check every few months or even every 6 months or every year, that's still a great way to keep an eye on the information that's there.
Okay, as a follow-up to that, does checking it yourself impact your credit scores?
No, I'm so glad that you asked that question. So when you check your own credit report, that is a soft inquiry. So you will be able to see on the credit report, you'll be able to see, oh, here's the date and here's me checking my own credit report. But soft inquiries never impact credit scores. Only hard inquiries can impact credit scores, but don't always impact credit scores. And as a reminder, a hard inquiry is when you are actually applying for credit. So when you're checking your own credit report, you're not applying for credit, you're just taking a look at the information in your credit report, which you have a right to do. So that will never affect your credit scores.
Okay. And as a sort of connected to that, someone is asking that companies that sometimes say that it's a soft check, but it turns out to be a hard check. How can a consumer know what is being done and what action can they take?
There's only one situation that I'm aware of where a company might say it's a soft check and it is a hard check. And that is a very unique situation where a new account is being opened. And there's only a couple of smaller credit unions that have this situation. There is a type of hard check for new deposit account being opened. So like a new checking account where there is a special type of hard inquiry that wouldn't affect credit scores. That's a very unique situation. But let me walk through an example of a company like Borrowell or a Mogo, for example. So these are alternative lenders, and they will tell you that it will not affect your credit if you check your credit file and get a credit score through them. And they're right, but let me tell you where that can turn against you if you're not paying attention. So they'll go through the process. They need to identify that you are who you say you are. So you go through, answer some questions, make sure that your identity is confirmed. And then they will show you your credit report and give you a credit score as long as you pass that identification requirement. That is a soft credit check. That is a soft inquiry on your credit file because all you're doing is looking at your own credit report. However, at the same time, they will probably put a little box up on the screen that says something like, would you like a $15,000 loan for 7.3% interest? You will be immediately approved if you would like this. If you click on that and say yes, you have just applied for credit. So that soft inquiry becomes a hard inquiry. If you don't click on that, then it remains a soft inquiry because all you did was take a look at your own credit report. So that's the part that you want to just be careful about, is you might accidentally create some more hard inquiries if you're saying, oh yes, I'm interested in this loan. That could be interpreted as an application for the loan, and that's where it may become a hard inquiry.
Okay. Now, as a follow-up to that as well, in terms of the hard checks, generally, what is the range of points that someone can lose when a hard check happens? So, for example, if someone has a credit score of 700 and they've got 2 hard checks or 3, how many basis points could they end up losing?
It's a very simple question, and I absolutely understand. It's not a simple answer, unfortunately. So I cannot give a range because I simply don't know one. It truly depends on so many other factors. It's kind of like saying, how many calories should somebody eat in the day, and not giving any more information about the person. Well, are they male or female? How tall are they? Do they exercise a lot? Are they just sitting around? Do they have any medical conditions? It's that kind of thing where there are so many other factors that go in that there just isn't a specific answer.
Okay. And now a question here is it a crime for any lending institution organization to check my credit without my authorization?
Oh, that's an interesting question. I'm not sure that I would use the word crime, but what can happen, it does happen on occasion that there's a misunderstanding. So let's say that you're standing in the branch and talking to somebody on the bank, or maybe you're on the phone with them, and they believe that they have obtained your consent. They have gotten your permission to check your credit because maybe they were telling you about some credit card and asking if you're interested in it, and maybe you said, oh yeah, maybe, and you thought you were just saying maybe later, and they thought you were saying, yes, I'm interested, I consent to you checking my credit history. This kind of thing can happen occasionally. What the option there is to change that inquiry from a hard inquiry to a soft inquiry. It cannot be removed altogether because legally it was an access to the credit report, and therefore it has to stay on the credit report. But under certain circumstances, and there's quite a lot that goes into this, it's not an easy process, but under that type of situation where there's a misunderstanding, it may be possible to change the inquiry from a hard to a soft.
Okay. Now moving to another one. Someone is asking if there's a joint loan or credit card with a partner. Will that be considered for both? Like their information, will it appear on both of their credit files? And then the follow-up to that is, what if I'm a secondary card holder?
Yeah, that's a great question. I'm really glad that you raised that. It really depends on the lender. So for some credit cards, they do report to both credit card holders, whether it's a primary and a secondary card, or if it's just like two cards that are equal. It really depends on the lender. So in my own experience, the way that I've gotten that question answered is I've looked at my own credit report. So when I have a secondary card on one of my spouse's credit cards, I've looked at my own credit report and saw, oh, it is being reported here, interesting. And there's nothing about it that shows that it's secondary. So it just is another account that is showing up on my credit report. So that can happen. There are some cards, and it just depends on the bank and the card, where they don't report the secondary card holder at all. So it's a question you can ask your bank card holder if you already have the agreement, like you already have the card, or if you're considering getting a card, you can ask them. Sometimes they don't know. The person that you're talking to on the call center on the toll-free line, they might not know the answer of how it gets reported. But there's another flip side to this that is an important thing to be aware of. I've seen situations where you have two people who are married and they share a credit card like this. Might be primary and secondary credit card. It might be just two equal cards. I can't think of what that would be called, but hopefully you know what I mean. So they use these credit cards for years, no problems, and then they get divorced. And the person that had the main card, whose name the account was in, it has only been reporting to that person's credit history. It has not been reporting to the spouse's credit history. This can be the case for some cards. Like I said, it depends on which bank it is and which card it is. I've seen this happen where somebody getting divorced realizes they don't have a credit history anymore. because the last time they had any credit that was in their name only was 7 years ago or 10 years ago before they got married. And it might not be because of any bad intent on the part of the spouse, but it just happened that any of the credit that they had happened to be in the spouse's name, and then the other person only had a supplementary card. So that's something to be aware of, that you want to make sure if you're in a partnership like that where you're sharing credit, that's another reason it's a good idea to take a look at your own credit file and make sure that there are some active accounts there.
Okay, great. Then the next question is, what happens if I discover that there are items on my credit report that do not belong to me? What are the next steps that I should take?
Good, that's an important one. So on the Equifax website, and TransUnion has this as well, the term that is used for that is that you want to dispute something that is on your credit report. And so very clearly on both websites, there is information about how to dispute information on your credit report or credit file. And so you're basically saying it might be that this account isn't mine at all. Or maybe you find it is your account, but the balance that they're showing is incorrect, or they're showing a late payment when in fact you never had a late payment. So there are a lot of different variations of incorrect information you could find that you want to make sure gets corrected. I can only speak to the Equifax process for doing that because that's where I work. It is becoming more online. It used to be a lot more over the phone and using mail, which like Canada Post mail, which is a longer and more frustrating process. So we are doing a lot of work to try and make it more online and more transparent so that it's clear what is happening along the way. So to give you a bit of insight into what happens, let's say, for example, that you look at your credit report and you see that there is a Visa card from Scotiabank on your credit report, but you don't have any accounts with Scotiabank. You don't have a Visa card with them. So you initiate a dispute with Equifax and say, like, this isn't me. Because that would potentially be evidence of identity theft, you would want to put a fraud alert on your credit file as well, which isn't something you can do for free. More information on our website there too. But what will happen once that dispute comes into the Equifax system is the people at Equifax will start to investigate it. So they will send communication to Scotiabank and they will say, okay, this particular individual is telling us that this account with this account number is not their account. Can you please investigate and let us know what you find? And then Equifax is stuck waiting to hear back from, and I don't mean to pick on Scotiabank, I'm just using them as an example, but whoever the bank is, they need to come back and say either, oh yeah, that person does have this account according to our records, and then we figure out what's going on. Maybe it's a same name and a similar address. So like some of the really large condo buildings in Toronto have a lot of people with similar names, like first initial and last name could be very common. So it's rare, but it can happen that information ends up on the wrong person's credit report. So anyway, we go back and forth with the bank to figure out what's going on, and then we'll send a letter back to you or communicate back to say, here's the result, here's what we found, and it has been removed from your file or whatever the situation is.
Okay, great. Then we do have another question here relating to credit cards, which is a few of them. How many credit cards should one have ideally to help with credit?
I really wish that I had a simple answer for that one. It's another simple question that you would think has a simple answer. A kind of guide or something to be aware of is that when somebody hasn't been using credit for very long, so you haven't had a credit file open for very long in Canada, that could be because you're new to Canada. That could be because you're 20 years old, and so you have only just gotten your first credit report, your credit card rather, even though you were born in Canada. Either way, when there's not very much information on somebody's credit file, then any little change can have a much bigger impact. So applying for more credit, having multiple credit cards could be a bit more of a red flag because there isn't very much to go on when the score is being calculated or when a bank or a credit card issuer is taking a look at your history to see whether you're risky or not. The opposite to that is somebody that has had a credit file that's been open for a long time, let's say more than 10 years or even 15 years, and they have lots of on-time payments and a really solid credit history. They've had many different types of credit, car loan, mortgage, credit cards, lines of credit, everything has been paid on time. That person can do a little more and not have a negative effect on their score. So a couple of examples would be applying for new credit. So a new hard inquiry comes onto the credit file. Let's use those two examples. We've got the one person who's got a credit file that's very young. It's, let's say, only a year old because this person has only been using credit in Canada for a year for whatever reason. Then you've got this other person who has a credit file that's 15 years old and has lots of information. It's very solid. So let's say these two people both go and apply for a new credit card on the same day. They're doing the same thing. There's a new hard inquiry that's going to appear on both of their credit files. Their credit files aren't going to look the same because there's lots of other things that are different, but they both get a new hard inquiry at the same time. The next time the credit score is calculated, this person with the long, solid credit history, they might not see a change in their score at all. Whereas this person might see their score drop a bit because that could be a sign of slightly riskier behavior. There's just less information to go on. So there was the question earlier, I know now, well, how many points? How many points is this person gonna lose? And again, I can make guesses, maybe 10 points, maybe 20. It just really could vary depending on the circumstances of that individual, their whole credit profile. It could be more points than that. So the same thing applies with having more credit card accounts in general. So this particular question was about how many credit card accounts is too many. I'm kind of paraphrasing the question, or what's the right number of credit card accounts to have? Well, if this person with a really short credit history has, say, 5 credit card accounts, that might not look very good on the credit history because, like, why does this person need 5 different credit card accounts? What are they doing? Is that a sign of they're in trouble and so they're going and trying to put a lot of money on credit? That could be statistically correlated with riskier credit behavior. Whereas this person who's got the long, solid credit history maybe could have 5 different credit cards and doesn't do anything on their credit score because there's so much more positive history there.
And just following up on credit cards as well, what are the implications of canceling a credit card and moving on to another credit card in a short space of time? Does that impact an individual's, how does that look like on an individual's credit report and affect the scores?
Yeah, that's another great question. It can impact the credit history. And this is a really tough one because there are situations where you need to close a credit card. So sometimes when people are starting out with credit, they get a secured credit card as the first card. So maybe you put down a $500 deposit and then you get a credit card with a $500 balance. A lot of people use that to build up a credit history so that then they can qualify to get an unsecured credit card, which does not require a deposit like that. And maybe you want to work up to get a better points credit card so that you can earn points on your purchases. These are all reasonable things to want. And maybe you need that $500 back of the deposit that you put on the first one. So that's a reasonable thing to do. But when you're closing accounts, one thing that you're doing is you're shrinking your average age of accounts. So that is one of the many factors that goes into the overall credit score calculation. And that's one of the reasons it takes a while to, when you're starting out with credit, to build up to get to a good credit score, because it takes a while to demonstrate that good behavior. It takes a while to build up the accounts so that you've been using them for a while, and that's where that average age of accounts comes into play. That's one of many different factors. So unfortunately, there is no right or wrong answer to closing a credit card or keeping a credit card open. The general, and I get this question a lot, and I just kind of awkwardly say things like I'm doing right now. The best advice I can give is, if you need to close a card, like you need that deposit back, then go ahead and do it and just keep demonstrating that good credit behavior, and your score will continue to go up. If you don't need to close a card, then you might consider leaving it open, even if you're not using that card very often, or it's not the main one that you use. If it's not if you don't have to pay an annual fee or something, then it's probably okay to leave it open and maybe use it occasionally so that it stays active. But there are also things that can happen beyond someone's control. So one example that happened to me was I signed up for a credit card, and I'm just going to tell you what it was. It was an Amazon.ca credit card where the points that I would get on it were towards gift certificates on Amazon. I may or may not make regular purchases on Amazon.ca. That's not the point of this discussion. I got this card, and I used it for about a year, and then I got a notice from the bank that issued the card where they said, we've decided to stop doing business in Canada, so we'll be closing all of the cards that have been issued, this type of credit card. My initial thought was, my credit score, that's not fair. I haven't had this card open for very long. It's going to bring down my average age. I didn't end up seeing any difference there. There may have been a slight blip, and then it evened out over time. There are situations like that where I couldn't control it. There was nothing I could do to prevent that card from being closed. So it certainly does happen that cards get closed. It's not the end of the world to close a card and open up a new one.
And there's a question around being offered an increase on your credit card in terms of the credit card limit.
Yep.
Does that impact your scores in any way?
It can actually help your scores because it will change your utilization. So remember, utilization was the difference between the limit on your credit card and the amount that you're using, so your balance. So let's say you've got a $2,000 limit and you're using $1,000. You've got a balance of $1,000. So you're at a 50% utilization. If they contact you and say, would you like to increase your limit from $2,000 to $4,000? If you were to do that, but keep the same balance of $1,000, you've just gone from a 50% utilization to 25% utilization. So that can be a positive for people in certain circumstances.
And does that constitute a hard inquiry, or it's a soft check? Because typically you get it offered by your bank.
Yes, so they can't do a hard inquiry without your permission. I believe that would be a soft check. So if they're offering it to you and then you accept it, you've already applied for the account in the first place. This is a change to the account. Some credit card issuers might then create a hard inquiry as a result of that, but I think it's unlikely. It would be worth double checking with them. Are you going to run a credit check as a result of me accepting this increase in credit limit? Would be a good question to ask.
Mm-hmm. And then there's one question around say, debt consolidation plan in terms of its implications on credit. If one is undergoing, say, a consumer proposal, you may want to just explain a little bit about what a consumer proposal is.
Sure.
They want to understand what, how quickly can they improve their credit scores to acceptable or levels where it can be considered fair or a good.
Okay, so just a quick review of when you're really having financial difficulty, a lot of people are aware of the option of declaring bankruptcy. So that is where you have to work with a licensed insolvency trustee, and that is a legal process where you declare bankruptcy and various agreements and things happen with your creditors. A lot of the debt that you owe will be removed, but also they are able to take some of your assets that you have as well. So bankruptcy is at one end of the set of options that you have if you are having a lot of difficulty financially. So bankruptcy is here. Then less severe is a consumer proposal. This also has to happen through a licensed insolvency trustee, and it is another legal arrangement that occurs where the insolvency trustee helps you come up with a proposal to go back to your creditors with. So let's say that you have a $10,000 balance on your Visa card. The insolvency trustee might, on your behalf, go to that Visa card issuer and say, there is a $10,000 balance here, but my client can only pay $5,000 of it over the next 3 years. Would you accept that? And so there's a process where with a consumer proposal, your balances don't go down to zero like they do with a bankruptcy. You still have to pay some of the money, so the creditors still get some of their money back. But because you still have not been able to meet your financial obligations, you still have that information as negative on your credit report. Then so we talked about bankruptcy at one end, then we've got consumer proposal, and then the next less severe option is you can talk to a not-for-profit credit counseling agency. And there are several of these across Canada. The important thing is that they are not for profit. There are a lot of scams out there, so you want to make sure you're talking to somebody that is a legitimate credit counseling agency. And what they can do is they're generally free for you. They can help you come up with a budget, help you look at your finances and figure out a path forward. If they think you need to go the route of a consumer proposal or a bankruptcy, they will tell you that and suggest that you talk to a licensed insolvency trustee, because a credit counselor cannot do a consumer proposal or a bankruptcy. But what a credit counselor can do is called a debt management plan. And that is a version of a consumer proposal, but it's on a much smaller scale. So there are a number of thresholds of like the size of the debt that is acceptable and the type of debt that can be handled using one of these three different methods: bankruptcy, consumer proposal, and debt management plan through a credit counseling agency. So in terms of impact on credit scores, they all do have impact. The worst one is bankruptcy. Consumer proposal doesn't stay on quite as long. I believe it's 3 years after the date that it's discharged, whereas a bankruptcy stays on the credit report for 6 years after the date that it's discharged. I believe a debt management plan with a credit counseling is a 2-year impact after the date that it's finished. All of these things, along with any other negative event that happens in your financial life, your credit life, they all become less and less bad on your credit report as they become older. So if you declared bankruptcy 5 years ago and it was discharged 5 years ago, so it's only one more year before it gets removed from your credit report, it's not going to affect your credit score as much as if it was only last year. So as it goes further and further in the past, it's not going to be as bad. As far as how long it takes to rebuild credit, it can take a while, because while you still have that negative information on your credit history, it is going to affect your score. And then once that's off your credit history, then you have that removed and your slate is clean, so to speak. So it is easier to then rebuild with good repayment habits.
Okay, great, thank you. So on the issue of addressing credit, we're coming to the end, only a couple more questions and then we'll wrap up. Just a heads up that this webinar is being recorded and you'll have access to it within 48 hours on our website, and I'll share that information so you can review it again. And if you have any further questions, feel free to reach out to myself or Julie. And this question is around credit repair agencies. People who say they can help repair someone's credit. Can you speak to that?
Yes, I'm glad that was raised. Credit repair is a bad term in our industry. There is no quick fix. Any company that is telling you that we can increase your score by 300 points in 1 month or this kind of thing, it is simply not possible. What a lot of credit repair agencies say they will do is they say that they will get information removed from your credit file on your behalf. So they will tell people that they've got some secret, some in with Equifax and TransUnion, where they can get in there and get negative things removed from your credit file. Here are some really important things to know. One is anything that is inaccurate on your credit file will be removed by you just asking for it to be removed. So there's no charge to do. You don't need to pay someone else to remove something from your credit file. If it's accurate, you show that evidence, then it gets removed at no charge. The second thing is, if somebody calls Equifax and says, I'm calling on behalf of this other person and they would like to remove these items from their credit report, the only way that Equifax will deal with somebody that is not the person whose credit report it is if there is a legal power of attorney in place that gives legal power of attorney to the person making the phone call. So a lot of these credit repair agencies are making claims about things that they can't even do. If they called up and said, I'm calling about Joe's credit report, we would say, great, we need to talk to Joe about his credit report. Are you Joe? Well, then we can't talk to you about it. So they can't make a lot of these changes that they're claiming they can make. If there is an error on your credit report, so let's say that there's an old bankruptcy sitting on your credit report that wasn't actually yours. So it looks like you declared bankruptcy last year when you didn't. So that would give you a very low credit score. Once that gets removed, you're going to see your credit score jump hundreds of points. If somebody is doing a testimonial where they're saying, this credit repair agency helped me increase my credit score by 500 points or something, there could be a situation like that where they helped you find that there was a bankruptcy that didn't belong to you on your credit file, and but it still would have to be you calling to fix it, and you can do that for free. So there are a lot of claims that credit repair agencies make. Some of them require monthly payment, and they're not doing anything for that money. So I highly advise people to take a look at what the claims are that are being made, and especially on the Canada.ca government website, there's a lot of good reference information about credit repair agencies and what to look for and how you can tell if a credit counselor is accredited, if they are legitimate. So I would highly recommend doing your homework there to make sure that you don't get caught up in one of these scams.
Okay. Thank you. So there is a question about whether a credit that you had previously in another country does apply to Canada.
That one is a simple answer, which is unfortunately it does not. There are a lot of projects and attempts underway to try to make that transition a bit easier. I could talk for about an hour on all the reasons that's very complicated. It seems like it would be very simple, but it's not, unfortunately. So at this point, no, you're not able to bring a credit report or credit history from one country to another.
All right. Final tips to say newcomers who are trying to build their credit in Canada. Any suggestions? Anything that you can share with them? I've got a few questions about that.
We talked a bit about using a secured credit card. That can be a really good option for getting your credit established. I would also say that you need patience. It does just take some time, and I understand that is a frustrating thing to have to wait for. But I would also remind everybody that a credit score is not a moral judgment or an assessment of your character or your worth as a person. So please don't get hung up on the number. If you've got a lower credit score and you're working to build it, then keeping up making the payments on time is really going to make a big difference there.
All right. So thank you so much, Julie, for your time, for staying a little bit longer as well to share your wealth of information. And there are many more questions. We could be here all day, but unfortunately, we have to bring this webinar to a close. And I invite everyone to keep in touch with us. So this webinar that's being recorded will be up on our website. So that is the link. We'll be sharing that. You can visit our website, accessccf.com, and you'll be able to access the presentation and the recording as well for you to review. And if there are any questions that have not been addressed, we apologize, but you can reach out to us directly, myself or Julie, and connect with us through our social media. And that's Julie there. So please feel free to connect with her as well. And she'll be able to provide further information that would address your questions. So again, thank you to Julie. And for those who don't know much about Access Community Capital Fund, we are a charitable organization. We help those who face financial barriers, such as having no credit or not so great credit, access loans to help them start a small business or to advance their careers in Canada. And we don't focus so much on the credit score aspect of it as a determinant of whether you qualified through us, but we look at your whole plan, whether it's viable, and as well as your ability to repay as well. We want to put you in the best possible a place to advance, whether it's in your career or it's in business, so that you can build that credit, or you can also rework on reestablishing your credit, as well as the loans that we facilitate do report to Equifax. So that's why we have Julie today. So I want to thank Julie again, and thank you everyone for joining us today. And again, do connect with us and keep in touch. We will have many more webinars addressing important issues and of concern, and that you have shared with us that you would like us to address. Thank you so much, and have a great day.